the long term, what do you think the U.S. market will be?
In what?
In the long term, U.S. markets, where do you see them going?
I think U.S. market, you mean in terms of size or valuation or?
In terms of performance.
I think that we're closer, long term, well, let's say 5 or 10 years, I think we have squeezed a lot out of the U.S. market. I think we're in an environment that we are going to have low returns going forward for a very, very long time, because if you look at returns, there's the present value effect of lowering interest rates and putting liquidity into the system. And that has largely run its course. And all assets compete with each other. So you can almost look at the yields of those assets. What's the yield on cash? The yield on cash, the yield on bonds, and then assets, equities, and so on, the risk premiums of each of those. And then that carries through to private equity, carries through to real estate, and so on. And because so much money has come out and interest rates were squeezed, we've brought asset prices up to very high levels in a historic context, but not relative to cash. They haven't gone to such extraordinarily high levels. And now in that tightening, as we're raising cash rates and the spreads between short-term interest rates and the longer-term expected returns get squeezed, that also squeezes those returns. So when you're at almost a zero interest rate, low in the United States, a zero interest rate in Europe, and a zero interest rate in Japan, which are the main reserve currencies, and that has all been supported by quantitative easing beyond that, I think we've squeezed out a lot of assets. I think the world, by and large, is leveraged long. Meaning assets, let's say the buying of debt, corporate debt. One of the biggest sources of returns on assets was the fact that the interest rate was low relative to the return on equity. And so there's been a lot of buybacks, a lot of mergers and acquisition, in other words, by companies buying companies and bidding that up, and that's been a factor. And that's also, then you had the tax boost, because if you lower corporate tax rates, companies are worth more. All of those things have pushed those asset prices up to levels where it's difficult to see how you can squeeze that. And so you can't get the rate structure down much, and which is the wind to the back, and you can't. So all of that means I think you've squeezed out a lot.